Welcome, everyone, in War Eagle. My name is Eddie Orantes, and I'm the Director of Business Operations for the Office of Alumni Affairs at Auburn University. And for the next 30 minutes, your host of 18 minutes and 56 seconds, the Auburn Alumni Association Speaker Series. As you can see, we're playing off the date of Auburn's founding, 1856, and this program is the newest way for you to interact with the Auburn family. What we hope to do is bring you a mix of guests in these upcoming weeks so that some will provide valuable information and updates. Some may help you cope or even thrive in these trying times. Others may make you laugh and entertain you. No matter what they do, we hope they'll bring the Auburn family, our family, closer together and have fun while we're doing it. Like the name suggests, we want to keep this fast moving. So all our guests will talk and present or do whatever they do for no more than 18 minutes and 56 seconds. That's 19 minutes, in other words. We also want to hear from you. So ask questions and interact by leaving comments on the Facebook page. We'll do our best to answer them in the half hour that we have together. Follow the program at aub.ie/1856 series. So now I want to bring in our first speaker, Dr. Damion McIntosh. Smart money management during COVID-19 is the topic of choice today. Dr. Damion McIntosh is an accounting, banking, and finance academic and practitioner who has 20 years of experience in finance, banking, and accounting. Currently, Dr. McIntosh is a lecturer of finance at Auburn University and banking supervision advisor and consultant with the International Monetary Fund. In the Harbert College of Business, Dr. McIntosh teaches graduate and undergraduate courses in financial markets and institutions, management of financial institutions, and multinational financial management. Dr. McIntosh, welcome to our speaker series. How are you?
Thank you, and thank you for having me. I'm great.
I'm glad you joined us. I'd like to start by first talking about your why. What keeps you motivated and engaged to discuss these types of topics, finance, banking, and accounting, at this present time?
Well, usually I'm always interested in the persons who I meet and interact with. And when we speak on the issue of budgeting or money management or finances or even retirement, these individuals would express that they either don't earn enough, they don't believe they earn enough, or they may be of the mindset that it is too much to be involved in budgeting their income or budgeting any cash flow that they receive or generate. And so it's always interesting to show them that it is something that they're already doing, maybe in an informal setting, or it might be something that they're engaged in, but they don't really realize that's what they're doing. So when persons say to me, oh, I'm just living paycheck to paycheck, they're actually managing that paycheck, but they're not really recognizing that that's exactly what they're doing. And so I like having that discussion with them because it's really just to give them a structure in doing what it is that they're already doing.
Wonderful. Well, that being said, and speaking about structure, there's a couple of questions that we have that we'd like for you to entertain and to share with our Facebook friends and family.
Okay.
Two of those questions I'll combine. The first one is what to do with the stimulus check that is received, and if you receive unemployment benefits, how do you manage both the stimulus check and that unemployment benefit once it's received?
Well, and that's a very interesting question. And one of the best ways to answer that question is to kind of tell you what not to do with that cash when you get it. Do not go out and buy a 75-inch TV because it's something that you want. That is certainly something that you should not do. Recognize the purpose of both cash inflow. The stimulus check, or more formally, the economic impact payment that you receive, is intended for that purpose. It is intended to assist in offsetting the negative effects, so to speak, that an individual experiences simply because of the pandemic that we're currently experiencing. And that negative effect can come from maybe a loss of income. It can come from a loss of a job. The unemployment benefit certainly is to replace the income as a result of maybe the loss of job that was experienced because of that economic crisis. So when you consider your normal expenses, when you consider your normal activities for which requires some sort of cash outflow, that's what the payment is intended to cover, so to speak. The difference, however, is you're now in a crisis. So it is likely that those expenses that you would incur under normal circumstances, you may now have to relook those expenses, determine those that are I define as discretionary and those that are non-discretionary. In other words, those that are essential, your rent or your mortgage payment, your grocery bill to buy gas in your car, those discretionary expenses, going to the movie, going out to eat in an expensive restaurant. And so what this crisis does is it now forces you to relook those expenses, prioritize those expenses, and then look to see how it is that this economic impact check, these employment benefits, can cover those particular expenses. One of the things I do want to point out, however, is it is important through this entire process to budget that check that you're going to receive. And what that requires is first being able to identify and itemize all your expenses. And one of the best ways to do that is look at the last 3 months. What have you spent your cash on? And if you forget, maybe look at your credit card statement if it is that you often use credit cards to engage in your transactions, or maybe look at your bank statement if you normally use checks to cover your expenses. And so by doing so, what it does is it allows you to identify, as I mentioned, those expenses that are discretionary and those that are not discretionary. Now, try to relook those expenses that are discretionary and determine whether or not you can actually do without those expenses in the next upcoming months. In fact, that's why you classify them as discretionary, because you can probably do without them. Identify and focus on those expenses that are non-discretionary. So I mentioned, for example, your rent, your mortgage payments, a couple of other bills that you may be likely required to pay over the next 3 months. Now, should you use a cash from your stimulus check or your employment benefits to now go ahead and pay those expenses? You should accept the following. We're now in a crisis. And there are a lot of creditors right now who are offering some forbearance to individuals. So if your rent is due, speak to your landlord and see what forbearance your landlord can offer. If your mortgage is due, speak to your mortgage company and see what forbearance can be offered. If you have a credit card bill that is due, speak to your credit card company. Your credit card company may likely waive any interest payments. And in so doing, you would only need to, say, pay the minimum payment on your credit card bill. Because what you're trying to do is ensure that you have enough liquidity, even though those expenses are due, if you can kick them down the road, if you can defer them at no consequence or at very little consequence to you, then you are able to hoard some of the liquidity that you're getting from these checks just in case things get worse. And that is one of the things that's extremely important now during this crisis.
So what I hear you saying then is preparation, preparation, preparation.
Preparation.
You have to be prepared for the crisis.
Absolutely. Don't get that check and think, okay, I'm just going to use it to pay my credit card bill. Or don't get that check to say, you know what, this is what I'm going to do. Ensure you've looked at your life, you looked at your lifestyle, and determine, well, how am I going to manage this cash inflow, considering the circumstances?
That's great. Let me remind our Facebook viewership right now that if you do have questions, please post them. We will have a question and answer segment in a few minutes. But let's continue with 2 additional questions.
Yeah.
And that is, how is my pension or pensions in general, how are they affected through this crisis? And what do you do about filing taxes if you've not done so yet?
Okay, well, let's first speak on the topic of pensions, and it's interesting you mentioned that, because just last week I got my monthly statements about how my plan is doing, and I refused to open it. because I refuse to recognize the impact the market has had on my pension plan. Well, here it is. When you make your pension contributions, your pension plan uses a cash flow to invest in the market. It can be the stock market, it can be the debt market, it can be whatever sort of financial instrument opportunity is available in the marketplace. And so the value of the assets as well as the return on those assets that are part of the pension plan is what is used to pay you or will pay you your pension benefits in the future. So if right now, if you're nowhere near retirement, then all your pension contributions are doing right now is being invested in the marketplace. And right now, I absolutely recognize that a lot of those pension plans have lost significant values because of downturn in the economy as well as in financial markets. Well, here's the thing. The market will bounce back. And so the values of those assets will bounce back. There's no guarantee it will bounce back to the level at which it was before this pandemic took place. But certainly it is nothing to get depressed about when you now look at this quarter statement and realize that your pension plan has lost so much value or your investment portfolio has lost so much value. You're in this for the long term. And so the market has cycles. And now it is in a downturn. At some point, it will regain some, if not all, or even more than the value that it has lost over the long-term period. So it's a matter of patience. It's a matter of holding on. There's no reason to, out of fear and anxiety, cash out now. What it requires is patience. The market will regain its strength. With regards to taxes, it goes back to the same issue of liquidity. We're fortunate enough that the IRS has extended the deadline for filing your taxes to July 15th. So that's like a 3-month deferral. And so what that means is you do have the opportunity, especially if it is that you will likely owe taxes and will be required to pay that money to the IRS, that you can wait to that later deadline to actually file your taxes. And it will not affect your economic impact payment that you will receive, because the IRS has determined that if you have not yet filed your 2019 tax return, that they'll make that determination based on your 2018 tax return. Also, during this period, if it is that you are required to pay the IRS taxes that are owed, you do have an extended deadline to pay that money. So you do not need to outflow that cash right now and adversely affect your liquidity. What you're trying to do now is maintain as much liquidity as you possibly can, so that in the event this gets worse and you do need that cash flow immediately, maybe to go to the hospital, maybe additional grocery shopping, for whatever other means, put gas in the car, even though gas prices have certainly gone down, but you do have that cash on hand, and certainly you have the credit line that comes from the credit cards that you're holding.
That's wonderful. Thank you for sharing that. So one is preparation. The other thing I'm hearing is patience, and then just using the right judgment and wisdom with regards to liquidity, because that's the priority. Question for you. You talked about forbearance. Can you explain what forbearance is? And the long, what that long-term consequence associated with that is.
Oh, absolutely. So what creditors do when they extend forbearance is they're sort of adjusting the original set of agreements that are in place to prevent you from defaulting on your debt. And that adjustment can come from a reduction in interest rates. It can come from an extension in the deadline for payment. It can come from a moratorium in payment, meaning instead of paying now or in the next 2 months, they'll allow you maybe to make your next payment 3 months from now. Or it can come from an extension in the tenure of your debt. You probably have a 2-year loan. Your creditor could normally extend that to now it becomes a 3-year loan. And what may eventually happen is that could reduce your monthly payment. A reduction in interest rate could also reduce your monthly payment. There are consequences of this, of course, which is why even though a forbearance may seem like a shining light, you have to be careful how hot that light is. And so it's important to understand from the creditor, what does this forbearance involve? Sometimes the forbearance may come at a penalty. Sometimes the forbearance may involve a lump sum payment, which at the end of the day doesn't necessarily put you in a better position. So for example, a creditor may say, you don't need to pay me for the next 90 days. So the next 3 months, I'll give you the opportunity to get back on your feet. But at the end of the 90 days, in other words, on the 90th day, you're required to pay the accumulated lump sum. Now, if it is that your circumstances are such that you will not be able to afford that accumulated lump sum, then that forbearance doesn't necessarily benefit you as a debtor. It's like the circumstances now with individuals who have student loans. And for the federal student loans, for example, and there is that benefit of a reduction in interest rate, or maybe that deferral in payment. Now, you can be very excited by that forbearance, but then my recommendation to you is this. If you can still afford to make your student loan payments, go ahead and do so. And here's the reason for that. When you make your student loan payments, a portion is carved out towards the interest, and a portion is carved out towards repaying the principal. Now, if interest rate is now 0%, if you continue to make your student loan payments now, what that means is 100% of that payment will go towards reducing your principal. So your principal gets reduced quicker. And what it also means is that the interest payment would now be based on a lower principal balance. So your interest accumulation will also be reduced for that purpose. So a forbearance is good, but understanding what that forbearance requires is also important.
Thank you. Valuable advice, and I appreciate you sharing that information with us. We've got another 4 minutes left, and I was just thinking about websites that may be available, some that you may recommend. Do you have any suggestions on places that one can go to get more information, resources to get more information on these topics that you just discussed?
Well, and here's what's interesting. I'm very careful of say, recommending a website, and maybe in that same breath, I should probably indicate that the views and perspectives that I'm expressing are those of my own, not of of Auburn University or the IMF as well. So I'm always skeptical in say endorsing a particular website. What I endorse is information and knowledge. And so what I would recommend to any individual is being able to get as much information and knowledge as possible about managing your funds and budgeting in the entire process. And I know there are individuals who will say to me, but I don't have any time to read, or I don't have any time to search. Well, here's a quick snapshot, which is what I've shared with you before. Look at your expenses. Divide your expenses into those that are discretionary and non-discretionary. Ensure, or try to ensure, that your income covers those non-discretionary expenses, those essential expenses. And then look at your residue. Your residue should not necessarily be used to now cover your discretionary expenses. It isn't. That residue should now be used to develop your emergency fund or your rainy day fund, as well as to invest and save. And I'm sharing this with you because even though our talk is about managing money during a crisis, managing money during a crisis really starts before the crisis. You really should start to manage your money outside of the crisis so that when a crisis occurs, it minimizes the adverse effects on your personal income. And one of the best ways to do that is you must always have an emergency fund, a rainy day fund. Well, I have individuals who say to me, but I don't earn enough to have an emergency fund. Well, guess what? You actually do. And here's the reason why. An emergency fund doesn't necessarily mean, well, you need to have $10,000 set aside. It is advised that you have at least 3 to 6 months of income set aside. But bear in mind something, that this fund does not need to originate in its lump sum. This fund will grow over time. So there has to be a starting point. You setting aside $5 this month, and you may say to yourself, well, that's not much. Well, think about it. If you set aside $5 each month, then over time, that $5 each month will grow. And if the next crisis occurs 5 years from now or 10 years from now, imagine how much you would accumulate over that period of time. So what that does is when you get a stimulus check or you get unemployment, what that will do is simply add it to your emergency fund or your rainy day fund. Now is a rainy day for you to be pulling down on that fund, which means if you do not have a rainy day fund, start a rainy day fund, and there's no better time to do it than now. And if you think you don't have enough income because you're unemployed or you've been furloughed, then what that means is you're setting yourself to have a deadline that once this pandemic ceases, once this economic downturn is now over and you're now employed, you will begin that rainy day fund.
Thank you. This is wonderful information. We're down to the last couple of seconds, and I'd like to just share a couple of questions that have come through.
Yes.
But let me summarize first the lessons that I've learned from what you just shared. One of those is prepare.
Yes.
Prepare. Second is patterns, and the other is planning. Being able to plan through this, excuse that sound, being able to properly plan is important. So here's one quick question for you that has come through. If you have the ability to make an investment specifically in the stock market, is this the time? Kind of following up on that conversation. And the second question is with regards to the stimulus check. How will the 2020 stimulus check affect my tax return next year?
Okay. Let's answer the first question. And this is without me recommending that you should go ahead and invest in the market or recommending in a particular stock in the market. As I mentioned before, the market is cyclical, right? Which means it's going to go up and down. And right now it's in that down effect. So stock prices right now are more depressed than how they were before. So if you're thinking of acquiring any type of asset, especially an asset that appreciates in value over time, certainly now is the time to be able to do that because the price is lower at this point in time. But here's what I think persons are interested in. Well, should I invest in the stock market right now so I can generate higher returns at some point in time? Absolutely, but the timing of that generation is important. So if you're going to invest in the market now where prices are lower and you do want to maximize those returns, you need to invest for the long term. It shouldn't necessarily be with the objective that, well, I'm going to buy stocks now, and then as soon as the market goes up, I'm going to sell my stocks and, generate the sort of return that I want. You can do that, but you're taking risks when you do that because there has to be another step after you've liquidated out of the market. What are you now going to do with that cash? What other investment alternative are you going to utilize? Interest rates in the marketplace right now are relatively low. The Fed fund rate is anywhere between 0 and 0.25%. So interest rates are relatively low in the marketplace right now. So if you're going to invest in the stock market now at the lower price, go ahead and do so, but stick it out for the long term. And what does that long term mean? That long term means if there is a second wave, which I hear they've been talking about in the fall, and the markets go down again, that shouldn't make you anxious. That shouldn't make you so anxious that you want to sell again and run from the market. If you're investing for the long term, it means you're sticking it out during the highs and during the lows, because you're investing for 5 or 10 years from now when the value of that stock has appreciated in such a way that if you choose to dispose of those stocks, it wouldn't be because of a crisis. The second question, I believe, was with regards to, the stimulus check?
And the impact that the check will have on next year's tax return.
Right. Now, the check that you receive is technically tax-free money. It is not taxable income. And so for your 2020 tax return, you will not be taxed on that you've already received. Recognize that this is a economic impact cash flow that the government is returning to you to say, we recognize the adverse effect that the pandemic and the economic downturn has had on you. What we want to ensure from an economic perspective is that you are okay, because you've been okay means a couple of things. You're going to continue spending. And if you continue spending, it means that businesses will remain open. If businesses remain open, it means that they should be able to continue employing their workers. And if they continue to employ, they should be able to continue paying. And if they continue to pay, those workers will be able to continue spend. And so what it becomes is a circular flow of income. So that's exactly what the government is doing. The government, because that circular flow of income has stalled, is kind of putting that money into your hands as disposable income to kind of continue that circular flow of income.
Wonderful. Thank you so much for that information that's shared. We're coming to the end of our sequence. And what I wanted to do is thank you, Dr. McIntosh, for joining us in this speaker series today. And I hope you come back and join us. To our Auburn family, I hope we can use the information that's shared to make smart money decisions during these unprecedented times in our nation's history. Please join us next week, April 30th at 11:30, when we will discuss mental wellness with our two guests, Dr. Dustin Johnson and Marquis Pasternak, when they will introduce us to A Sound Mind, a site to provide easy access to resources based on individual needs. Please stay safe, and War Eagle. Thank you, Dr. McIntosh.
Happy to be here. No problem.